Joining us today is Joe Davis, President and Wealth Advisor at Stonebriar Wealth Management. Joe, always a pleasure to have you. Welcome back.
Thank you, Jonathan. It's a pleasure to be here.
So we had you here Q2 and Q3, and both times we were talking about market volatility. Now it's Q4, and it seems like the market is even more volatile than ever. With all the moving parts, how can investors tune out the noise and realistically manage their expectations from here?
Well, you certainly said it. This has been a volatile year. There's been a ton of noise. But broadly speaking, this market is very uncomplicated. The global economy has an inflation problem. Whether you're buying a new car or a pumpkin, we've all experienced it. It's in the data. There are signs of inflation peaking, but it's not conclusive enough. And when you have an inflationary environment, you're susceptible to exogenous shocks. And we have had our fair share of shocks this year, as you probably are aware. We've had the Russia-Ukraine war. I mean, a terrible human tragedy. It's caused commodity prices to spike. We've had the zero COVID policy in China, the lockdowns. Sporadically, without warning, one of the largest economies in the world shuts down with zero output for an extended period of time. And then most recently, PM Liz Truss in the UK, there was a completely unforced error that was completely avoidable by announcing her mini budget. And it's good to see, yes, the Chancellor of the Exchequer outed in less than 2 months, but there was pretty significant damage done. So at the core of all these different shocks, it's inflation. And looking at the CPI data month over month, looking for a softer number for the PCE index, the preferred index of the Fed, we need to see a meaningful decrease in inflation, and we just don't have it. And until we see a softer number in CPI, the Fed is going to continue to be hawkish. And they have proven to be the most hawkish central bank in the world, and surprisingly so. It's amazing where we've started and where we've come in a very short amount of time. But as an investor, it all comes down to don't fight the Fed, listen to their rhetoric, listen to what they're saying, and it's an inflationary problem that we have to focus on.
Historically speaking, does the current market remind you of any periods in the past that we've seen?
I think more importantly, it's good to get certain periods out of the way that don't remind me of right now. So in 2008, right, that was an existential crisis where everyone was wondering if certain banks were solvent, if insurance companies were going to go under, if there was going to be money in the ATM. In 2011, the newly formed EU, we weren't sure if Greece was going to be bailed out, and it kind of put the Eurozone in a very unique position that it hadn't been in before. 1998 comes to mind too. A mountain of emerging market debt caused for a bailout of a major hedge fund, LTCM. So with all of these different disasters, we were on the brink of financial crisis, an existential threat to the market. Today, we do not have that. Everyone remembers 2008 because it is recent. We lived through it. We experienced the Great Recession. But that doesn't necessarily mean that that was a run-of-the-mill recession. Today is more of a run-of-the-mill recession. So unemployment is low. We're below 4%. We're adding jobs. Earnings season just started, and we're beating expectations so far. So we're seeing good, positive silver linings to this market. 2000 to 2002 does have some similarities. There was excess in the market. Valuations were too high. The Fed was hiking rates. There were 3 bear market rallies when the Fed decided to cut rates, but until they got the Fed funds rate to a comfortable place and could slow down inflation and also spur economic growth, the Fed funds rate ended up at 1%, and unemployment was at 4%. And after 2002, there was a long period of sustainable economic growth. And who's to say that we're not going to see that on the other side of this bear market that we're on right now? And the last era that comes up often is the 1970s, 1972 to 1975. The key difference is there was significant political and economic turmoil in the world. There were embargo acts. The Fed, inflation was running rampant. It led to stagflation. The Fed was not aggressive enough. They flip-flopped. There was policy mistakes. It's just a bit different economic backdrop today than it was back in the 70s. So it's not as dire as it seems. It's not 2008. It's not an existential crisis. Again, it's an inflation problem that we have. And the Fed will get it under control. Global banks will get this under control. It's going to cause some pain, as they said, but we'd rather be in a recession than an inflationary environment.
Well, Bloomberg just put out a forecast where they model 100% chance of a recession in the U.S. in the next 12 months. So the question about a soft landing, really, it's gone out the window, and everyone now is asking when this recession will come, how deep it'll be, and how hard it will hurt. So what are you telling clients?
A soft landing, what a great idea that was 9 months ago, right? Look, I do think a recession is unavoidable at this point in time, but if you look at what the Fed is doing, we've hiked rates. We're at 0 to start the year, and now we're priced in nearly 5% to start the year. So I think there is a very good chance that as we enter a 2023 mild recession, inflation starts to peak, the Fed can revert more to a dovish tone, and essentially do what's called the Fed pivot, right? If you think about a pivot, we're going one direction with raising rates. If the Fed can pivot and do the opposite and start lowering rates, that will cause the market to really rip. And it's not a far-fetched idea. The market's actually priced it in a few times already this year. This summer, there were very, very high hopes of a Fed pivot coming sooner or later. It hasn't happened yet. But once a recession does hit, the Fed will have its hand a little bit more forced to implement a pivot and get us out of the mess that essentially it's causing itself, and that's what it has to do to get inflation under control.
Well, to add to that, I heard an interesting stat that I absolutely loved, that the economy or the markets have never have never bounced off a bottom without the Fed pivoting.
Is that so? I mean, don't fight the Fed. This is your reminder for those of you at home. And it happens. It's true. The Fed can be your best friend or it can be the enemy. In 2008, when they bailed out this economy, they were our friend. Right now, hiking rates, destroying the economy, and destroying is a tough word, but they've used the word pain over and over again over the last few months, causing pain on this market. That leads me to believe they are the enemy until they can be back and pivoting to a more easy money policy. At that point, the Fed will be in a position where it's raised rates at an unprecedented speed and to a level that it can still cut back without worrying about rates, the Fed funds rate getting anywhere near 0, and start to stimulate growth, stimulate investment, and get us back into the next market cycle.
So one of the victims of the increasing Fed funds rate is equities. So a lot of people are talking about it being the death of the 60-40 model. What are you telling your clients, and what are your thoughts on that?
I went on social media a couple of years ago and held a moment of silence for the 60-40 portfolio. And look, if there was any key characteristic to the last 10-year rally and bull market that we've had in the markets, it's been an easy monetary policy, a low interest rate environment that stimulated growth and investment. If you fast forward to 2022, as I mentioned, we started the year at a 0 Fed funds rate, and now a 5% rate is priced in just less than 12 months. So what happens, remember, when interest rates rise, bond prices fall. No one wants a 2% bond anymore if they can go out and get a 4% bond. So what does this mean for investors? The bad news is that if you had long-dated treasuries, historically a very conservative investment, 20, 30-year U.S. treasury bonds, you're down over 30% this year, which is not far off, actually right in line with the NASDAQ, the tech stocks. So that has been a very, very difficult thing for your more conservative investors to grapple with. That being said, when something goes on sale 30%, oftentimes the next shoe to drop is a reversion to the mean. So here we are today. The Fed funds rate continues to increase. You can get 3% in a long-dated Treasury portfolio as you wait. You can get 4% in a corporate bond. You can get 8% in a junk bond portfolio, and the tax equivalent yield on a muni bond portfolio is actually quite similar. And oftentimes there's less of a default risk there with the munis. So there are significant opportunities, and because the Fed has moved at ludicrous speeds, it feels like it almost happened overnight. But the 60-40 portfolio is certainly back in fashion, and until the risk remains that until the Fed is peak hawkish, until we have that kind of peak inflation number and inflation starts to recede, the risk is that rates continue to rise. So dollar cost averaging, and that's why you work with an advisor, right? To make sure you understand the risks and you have the right time horizon and the right entry points. And using dollar cost averaging could be a really attractive way to get fixed income exposure now.
Joe, in Stonebriar's view, what economic factors should investors be looking at, and what actions should they take in managing their portfolios?
So we're in the late stages of a bear market. The average bear market lasts 9 months, and here we are approaching 11 months. So as painful as it is, it's too late to sell. 7 out of 10 years in the market are positive. We're in one of the 3 out of 10 years right now. Newsflash. So investors spend a lot of time trying to forecast what year is going to be one of those 3 years that are down. But again, working with an advisor to set expectations, set your time horizon, and there is a light at the end of the tunnel. And it's only been 2022 so far where markets have really have gotten hit hard. And it's hard to deal with that, and it's hard to see a portfolio down. But a portfolio being down is just temporary. A mistake that can set you back years by selling at an inopportune time, that can be permanent. So those are the types of strategies and ideas that we communicate with our clients. We make sure that they're well aware of so they can avoid those life-altering mistakes at times and see the light at the end of the tunnel in their own portfolio. Specifically, there are 7 events between now and the end of the year to watch very closely. And I can't remember a time, maybe since 2008, where it's been must-watch TV like it has been now. I mean, eyeballs glued to a screen at 8:30 in the morning on a Wednesday for one number that moves the markets one way or the other. And that's where we are right now. We've got 2 more CPI readings, inflation. We've got the UK fiscal budget announcement. We've got 2 more job report meetings, and we've got 2 Fed FOMC meetings where we'll have minutes. So, must-watch TV. Don't get too caught up in those numbers, but for those who are looking for a way out, for when the Fed can pivot, for that light at the end of the tunnel, these are the first kind of opportunities for us to look at, what's happening with inflation, how is the Fed reacting, are we headed into a recession, and can add a little bit more of a timeline to when will all of this end. And 2023 isn't far off. So what does that mean for investors? You may not like the way the medicine tastes, but it's the best medicine, and it's to wait and get out of this on the other side, because we will get out of this, and not to make any rash decisions as markets are in flux, because it's been a very tough market. We are in the final innings of a bear market, and there are opportunities out of this, namely inflation and the Fed's response to it. Because once the Fed responds, it's going to certainly be a very, very fast and significant rebound.
Well, Joe, always a pleasure to have you in studio.
Thank you, Jonathan. It's great being here. Thank you.
And to our viewers, thank you for watching. For Asset TV, I'm Jonathan Forsgren. We'll see you next time.
Stone